Hi there, it's Bill with Smart Trades, and it's let's see, about 11:40 on June 10th, and just wanted to update my outlook and also review the calls from a few weeks back. Um, First, let's look at what we said a few weeks ago, and again, we had looked for a peak around the 1222 to 1223 area. The market actually peaked just shy of there at 1219.80. Then we're calling for a decline into that previous fourth wave low, which you can adjust a bit, but the bottom of that previous fourth wave, and this is the actual chart that I had posted before, was around 1030, but not necessarily getting that low, but that's the bottom of the previous fourth wave of one lesser degree, according to my count. Now here's how it turned out. We actually got to 1040.78. I think that is a short-term low, and so not quite an exact hit, but pretty darn close. Here is our shorter-term chart on the that I used on the last report, and we were calling for a peak around the 1175 area on the S&P before that declined down to 1030, and indeed we got to 1173.56. Not again an exact hit, but just a point and a half off more or less, and then we've declined from there down to the 1040 area. Okay, just I had heard on another report somebody was criticizing my count, saying that having the exact price is pretty much the exact price projections is pretty much worthless. It's the same as just having counts that review the past. And I have to tell you, I think that's one of the most idiotic things I've ever heard. If you can predict the price action, even if you don't know the exact path between price B and C, as it were, but you know exactly where the market is going, that's a huge advantage over the vast majority of people who have no idea where the market is going, where it's going to top and where it's going to bottom. And so, you're not always going to be right with these kinds of specific projections, but having those numbers is very valuable, if for no other reason, to see how the market reacts when you get there. But it also gives you an element to hopefully limit your risk if you know where the market should top and bottom, particularly if it's within, say, a point and a half, as the projection was earlier this month, or actually back in May. Okay, here's a review of the S&P cash on a 130-minute chart. And one of the problems I've had with the counts is that I've been counting this first decline as a 1 or an A, and I've wondered about that, because when you look back and look at the rally through February and March, I think that rally best counts as an impulse wave. And here is how I have it labeled: 1, 2, 3, 4. And I was looking for one more final peak at the end of this rally back in late April. We didn't get there. In looking at it, reviewing it again, I wonder if in fact that wasn't a failed fifth. If you use a close-only chart either on a daily or 130-minute basis, this really makes things work out, in that you can count from that failed fifth high 5 waves down, which we can count either as 1 or A of a correction, and that gives us a target up around 1105, 1110 of the previous fourth wave of less degree as the next resistant. Whether or not that's going to be the peak of this thing remains to be seen. There are other counts that you could look at, but that's certainly the first place I would look, and I do believe the market has put in a short-term low. We'll take it one step at a time from there, though, and see if we do indeed get up to that 1105 area, and if we have a terminal corrective pattern up there. Okay, here's the S&P cash again, and this is looking at the more typical count. There's a guy, Trader Joe, who's counted it this way. This is one of Prechter's alternate counts, and in fact, I actually counted it potentially this way as well. And this is looking at the first decline as 1. From there, you have a rally back 2 that fails to make a new high, obviously, and then you can count within the third wave and 1, 2, 3, 4, an extended fifth wave to complete 3, and then a rather sharp and rather deep corrective wave 4, and then 5 waves down for 5, which we can count as 1. Now, what's interesting about this to me is the depth of wave 4. It's not only interesting, but it's a little bit. It causes me to wonder if the count is correct. But it doesn't break any rules. It certainly could be a plausible count, and if it is, check this out. This is the weekly chart at the S&P cash, and it's almost you know, a carbon copy, just on a different scale of the counts that we have on that hourly S&P of the recent decline. With, again, wave 1 down, you can count 5 waves within 1, corrective rally. We can count this as a triangle fourth wave within 3, and then again, the triple zigzag, which is a very popular count, rather than what I've counted here as an impulse wave up. Now, the triple zigzag, I'm not saying it's impossible. It's certainly possible. And again, the point here is that this is, if this is a fourth wave, the implication is that we're going to go all the way back down below the 666 lows basis, the S&P, and it would make for a very interesting scenario, because all the bears would be saying it's the end of the world. They'd all be getting short and celebrating and so on. Anybody that's long along this rally is going to be wiped out, or, you know, at least having to have gotten out. And, you know, there's a whole bunch of targets that I have down around the 630 level. I'll get into that more in a later report. It's even the area where the market had hit before exploding in the mid-90s. Is kind of a departure point. So it would be very interesting to have the market revisit there and then hold. But anyway, we're getting way ahead of ourselves. We'll have to see how it plays out. We'll take it one step at a time, as always. And for now, we are looking for a bit of a correction and a corrective rally that would be back up to at least, say, 1105. But we'll take that indeed one step at a time as well. Thanks for watching. Have a great day.